Welcome back to Trend Following Trading Ideologues. Friday morning, every Friday event at 8 o'clock Eastern Time. I've been very busy, so I'm a little behind on my Twitter. A lot of stuff going on Twitter, though. I've been watching. I've been getting the notices. So I just have been missing out because I've been too busy with these markets and finding stocks and adding stocks. Yeah. So it looks like things have turned around a bit with the bond market downtrend and definitely the dollar uptrend. And so this is what we do. We just go with these trends and make the best of it. I wanted to apologize for last week because there was a question out there and I thought it was from Bruno. But then when I looked closer, it was from Cordura. And I could have I was waiting for Bruno to be on the spaces and he never was. So I didn't bother with the question. But then I realized it wasn't Bruno at all. Cordura 21, long time friend, trend follower. And so anyways, it's a good question. So I'll just read the question. We can talk about this if you want to. I have some opinions on this question. How can I propose? Okay, maybe a little technical. How do you keep track of different systems under the same AUM account? For example, you have two variations of a breakout system under the same account, but with different open closed equity. So I like to keep track of closed equity, open trade equity, let the profits run on the open trade equity, and then base my trade level and my position sizing on ATR and the closed trade equity. And so I trade 4 systems. I think Richard trades like 6 or more. And so he's saying two can be trouble as well. And so you don't want to keep these things separate. I just keep a total trade, closed trade equity, total open trade equity, and don't pay attention to how each system is kind of performing. As I've said many times, my trend following systems are different look backs, different holding periods, medium to long term, and they all make about the same amount of money in the back test, but over short periods of time, year or two, they could have very different performance. But I just don't split up the equity in that way. I do split it up into 4, 25% for each system, but I don't keep track of system 1's closed equity, systems 2 closed equity, et cetera. So I think that's probably a good way to do it. And so then I wouldn't have different unit sizes for the British pound and system 1, system 2, system 3. They'd all be the same position size, unit size, risk commitment to each market would be the same for all the systems. So I think that's probably the way to do it from a robustness math point of view. But it's the way that I've always done it because that's how I was taught to do it. So simpler is better, I guess. Okay, Oleg.
Hi to everyone. Hi Jerry. Hi Moritz. Hi Richard. Hi to all the guys. Hi to Jerry Smith. So I'm in the Black Sea coast, Novorossiysk, South Russia. It's rainy weather here. We have very rare snow, maybe only a few days a year, maybe maximum 10 days a year we have snow in South Russia, and I love snow. And I see snow on the mountains, some snow. But I'm very happy that I'm here, and I even don't, when looking in the window, maybe I looked at the window and I felt a little upset, but I remember that I have this magical trend following trading ideologist club, and that I'm a trader, I'm a trend following trader. So no matter what the weather is, or maybe some circumstances are, because I have, and I always say this, I have such things that are making me happy. And people ask me, why are you so happy? What is the secret? And the secret is to find something what you love. and to find friends in this field. It's a real secret of true happiness, I think. To grow and to grow. As Tony Robbins said, to grow and to give is a recipe for happiness. And I agree with this. Okay.
Hi, Jerry. How are you? Just wanted to add that, to that question. It's a little bit technical, so I don't know if it's used to speak about this here. But uh, since I come from the accounting profession, I kind of like to separate things, and I keep a different equity for each of the subsystems that I use that are four. And also, since I'm training in interactive brokers and they allow me to make sub accounts, I really run them on different, like they were kind of different funds, so to speak, and then I rebalance them at the end of month. But it's just because I could do it. But now I'm thinking about maybe simplifying stuff. Just wanted to say that.
Yeah, I mean, on the back test, I will obviously back test all the systems separately to see how well they do, the trade stats, of course, most importantly, and see how they. I like to keep that. I really find comfort in the fact that all of these systems make the same amount of money over, the back test period, but, they can go up and down. And, I think we had this going on Twitter where, the trend following systems, medium to long term, that I trade, and probably a lot of other people do as well, they, when you get going in these big trends, they're 100% correlated. Hopefully, thankfully, you don't want to have a trend following system that misses OJ. Oh, it missed OJ, but that's good because it's less correlated. No. There's nothing good about missing OJ, okay? You don't want to miss that trend. So when you have these big, long, especially if it's a sector move, short the dollar, long the dollar, and short the bonds, then your correlation between the systems and the markets is 100%, which is good. And then when things start to turn a bit, you will start peeling things off, getting out the shorter term systems first, and then maybe it keeps going lower, or then maybe it reverses and goes back to in line with the previous trend. And so that's your main diversification by trading the different markets in the same sector or the different time frames in the trend following systems is going to be your P&L diversification. So, the short-term systems may make 50 ATRs on a trade, the longer-term ones 25 or 30. Or if the trend resumes, the longer-term systems will keep that position on with the original ATR, this huge, massive position with a very small ATR that you put on a year or two ago, and then the long-term systems will end up making more money. So it's really the diversification of the P&L that you're really banking on, and the correlations are going to be high when you're making money, and I like that. I'm not going to shy away from all my positions doing well.
Yes, I also like very much this diversification. I love all kind of diversification because it's so wonderful. And in fact, we pay nothing for this. So we must only have a good enough deposit. But there is no price for this special price, as I have heard, that it's a free lunch, only free lunch in finance. So I like really how it works when I see one system, even in backtest and theoretical accounts. It's so wonderful when you see this this maybe compound effect or something like that. But and I see how this drawdown can be reduced even in a non-trending environment. Diversification. If we have, for example, 100 markets, no one is trending, but diversification reduces the drawdown. If we had, for example, one market, because even if in the same sector, because some of the signals are not working, are not in work, and we don't lose money. And so it's very powerful tool, really very powerful.
G'day, Jerry. G'day, Oleg. Oleg, while it's snowing over there, it's boiling down here. So it's one of these very hot summer nights in Brisbane, Australia at the moment, and I'm boiling. But look, Jerry, you raised a very interesting question. Just in talking about correlation. So most people, when they're thinking of diversifying in the markets, are saying, "Oh, all of these markets are correlated." But I'd just like to raise one point. Correlation is actually a result of how your systems interact with that market. So you mentioned how you thought I had 6 systems. Well, 2023, Jerry, I'm following your path. I'm now, as at February, about to launch 15 systems per market with 70 markets. So I've sort of upped the ante a bit. I'm sort of focusing a bit more at the moment on system diversification, but there's a reason for that, because I'm finding in my research that the more systems you apply to a single market, the less correlated the trade outcomes are to other markets. And this is because the systems themselves, the ensemble of systems, is doing a very important thing. It's breaking down the correlation that exists between markets because of this interaction between the systems and the market. And what's happening there is that the systems, because I'm using trend following systems with different entries, different stops, and different trailing stops, all with small bets, they're all applying the golden rules. There's a feature called co-integration coming into play in my portfolio, which is more it's a structure. It's a way to break down correlations using structural design features. So we've talked about this before. A perfectly hedged trade is a co-integrated trade. It's basically using structural features to basically be uncorrelated with the market it's trading in a hedged trade. But when we're applying ensembles of systems, and now I've got 15, I'm finding that I'm getting far lower correlation across my markets, which therefore allows me, with system diversification, to then expand wider using market diversification. I think this is really interesting, because what I'm finding is that I'm getting a symptom that I think you're finding, Jerry, in that the more you diversify, the more outliers you're capturing, and the less correlated your overall portfolio is going to be, provided you are targeting uncorrelated return streams. So how I'm doing that myself is using system design features to break down that possible correlation that could arise between trading fairly highly correlated markets because of the way the systems interact with that market. I hope that makes sense.
Yes, and of course, we are totally focused on hunting these outliers and realizing that we're going to get ourselves into some higher correlation situations than most people, because we think that Brent crude and WTI crude can have different trends. And we sort of saw some of that happen with the interest rate sector, where some of the bigger moves were in the short-term rates. So we're not paying much attention, or we're not being driven by smoothness and the smoothness and the correlation, not even getting into the fact that these correlations change a lot. And I've made a lot of money in heating oil over my career. I've told those stories about heating oil trades where heating oil made a ton of money, and crude kind of sat there, 80, 84, 1990, and then silver, same thing in 87, had a big, huge move, gold, nothing. So that is where we're going to put most of our focus, not on this kind of smoothness. And, with 300 markets that I trade, if I screw up, the correlation and trade too much energy or, too much grains, it's really not going to show up very much in my take small losses across the board in energy. It's not going to, it's 15 basis points per loss. It's not going to really show up that much. So that's another benefit of trading all these markets. Hunting, I'm finding more, and I'm getting a lot more diversification and even screwing up. With trading too many of something, it's not going to really hurt me very much. But it's really fun to add the interest rate ETFs along with the interest rate futures markets. And there's I was able to get long some of the ETFs because they just had different chart patterns. So that helps as well. Good morning, Absolute.
Yeah, hi everybody. Yeah, I'm in Europe now. It's afternoon now here. And
Jerry, can I ask you a question?
yeah, I'm curious I didn't get a lot of responses to the question that I posted to the group. So I would like to have some answers on the question that I posted maybe a few days ago in a hypothetical question. And this goes along the lines of, I think now some things started to crystallize to me as to why I believe certain things. And first they were intuitive, but now they're starting to gain a little bit more of a logical and a scientific basis as to how things are connected. And like my preferences in certain aspects of science and statistics and complexity. And for here, what hit me and what I found fascinating about the Fortune's formula and about the books and about the book Fortune formula and ergodicity and risk of ruin is how risk pooling and risk sharing actually decreases the odds of risk of ruin, and how concentrating risk actually increases it, even though you're concentrating it to a process that you may think is superior to the others. But I think even in Fortune's formula and even in the ergodicity literature and even in portfolio management theory, there's an argument that because geometric return is always smaller than arithmetic, the geometric mean is always smaller than the arithmetic mean, and it's affected by volatility. There are ways for you to combine different strategies, and there is probably even a way to combine a strategy into your ensemble of revenue streams, which even if it has a negative arithmetic mean, so a negative expectation, but combined with the rest of your ensemble, it produces improved geometric mean. So this is what I found fascinating. So adding a strategy, adding a revenue stream with a negative arithmetic mean could increase the geometric mean of your total ensemble, therefore your final net wealth. And how then I started to, so I knew this, like maybe a few years ago, I've been aware of this, and I've been applying it in my model and my strategy. But what it hit me last week was to connect it with our argument about position sizing and about whether size should be adjusted or not, or hunting outliers. And therefore, I had that question, which I thought kind of would be a food for thought for people here to kind of think about it and just give me an answer and then explain why the answer is that. So I don't know if I can, let me find that tweet, if I can repeat it. So assume current net worth of $10 million. So case one, 5 million of that current net worth is in open profit, and the 5 million is the distance to the trailing stops. So basically, if all your trailing stops get hit, you'll lose the 5 million, which is now part of your net worth, out of your 10 million. And they're all concentrated in 5% of your ensemble, not necessarily your markets, but of your ensemble. So of your ensemble of strategies and markets. So this is case one. Case two, 5 million of your net worth, which is total of 10 million, is in cash, ready to be put into your strategy. Do you put them in those 5% positions, 5% of your ensemble, as what your strategy would suggest from case one, or would you distribute it in all across your all ensemble? So I would like to hear some answers to this question. I think we can, if interest is enough, we can open a discussion. But I think this is a good initial question to ask.
It's a great question, absolutely. And look, so I'll answer from how I'd approach that problem. I've never got into that extreme example. But if, for instance, I was committed with 50% of unrealized equity, as the example you posted, if I was committed with that with 5% of my ensemble of systems, the balance or the 5 million left available to me would actually be investing in different markets. The reason I do that is because my rules of my system are that if I have 15 systems, that gives me the ability to commit potentially 15 positions to an outlier. And let's say I was fully loaded with 15, like with orange juice. Let's say theoretically I was loaded with 15 positions in those systems, all attacking orange juice. And let's say that equity was extreme, that unrealized equity of, say, 50% of my net worth. If it ever got to that level, I'd say it would never get to that level, but that's a different argument. But if it did theoretically get to that, then I'm prevented in my system from actually putting additional bets into orange juice, which means that the balance of my capital, let's say 5 million left, would be forced to just be available for alternative markets, not to that orange juice trade.
Okay, yes. Can I interrupt? Yes, Richard, I understand that. But so the question really is, let's say all your 15 systems are fully committed to orange juice, and orange juice does something within 1 or 2 or 3 or 5 days. It just goes completely in your favor. And now the open profits and the distance to your trailing stops is actually 50% of your net worth, not just your strategy, of your net worth. So basically, you are now faced, you're looking at them, the market gave you what you asked for it, and you're just watching it now, okay? So you have 50% of your net worth in orange juice, and you're standing there ready to watch it. If all your trailing stops get hit, if it goes back down in 3 days or 4 days or 2 weeks, it goes back down, you lose the 50%. And then I agree. My point is, you don't have to add additional closed equity or cash capital so for your percentage of net worth to be affected. The move of orange juice itself can produce open profits, which are 50% of your net worth, without you adding extra capital to it. So I agree.
I get you. But see, because I'm using these chandelier stops, it wouldn't actually work quite like that. If, for instance, I was just using an initial stop, it potentially could get like that, but it never gets into that position. But theoretically, let's say it was such an extreme move that it did get into it. Do you know what I'd have to do? I'd have to follow my system, absolute. And you'd say that's absolutely stupid because I'm losing out on opportunity cost. But it's just the way I'm ingrained. It's this dedication to following this systematic process. That's all I can say. I can't really defend it apart from the fact I must stick to my rules.
Okay, so yes, I fully respect that, and I agree. My argument is, you can build a system which you can fully be committed to and be 100% systematic to without breaking any rules, which will allow you to maximize diversification. And by maximizing diversification is, what do I mean? So if the logical answer from the optimality perspective, in the sense that, hey, I have now $1 million that the market gave me as a gift, which are now all in orange juice, and you, because you're an ideologue, you're ready to watch them go to zero. So you'll go back to your 5 million net worth from before. Because so that's what you believe in, and fine, I respect that. But from an optimization point, like if then that will be an open profit. But then in case two, the question is, let's say you did not have this trade in orange juice, and you're watching your system, and had you been in the system, you would have been up 5 million in orange juice, and you would be, again, you accept them, and you'll watch them go back to zero. But let's say now you're following you're paper trading your system, and your system is now telling you, now orange juice made this move. Now you have 5 million of net worth, which was in your previous system without orange juice, and you have extra 5 million, which is now in cash. This is not a gift from the market. This is not what the market gave you in orange juice. This is 5 million that you have in cash in your bank. And now you want to put it into your system. Would you put them all in orange juice and lose them all to zero? Because to me, these things are equivalent. The market gave you the gift. The equity is the equity. The dollars are dollars. You have the option. You have the freedom to take them now if you want. So whether you put them now as cash, or whether the market gave them to you as a gift, the dollars are the dollars. So my question is, what is your answer to the second question? Would you put the 5 million of fresh cash into orange juice, or would you allocate 5 million to the whole strategy? But in your case, it may mean, hey, the whole strategy is now 5 million in orange juice. I have to put them. But you can build a strategy that at all times tries to diversify risk. And there's strategies that no matter when you put cash or take cash out, the goal is to always be maximally diversified. So my question is, for your strategy, would you put the fresh 5 million into orange juice, or you say, forget orange juice, it already had its run, I'm just going to put 10 million for the rest of the market, just wait for new trades, or allocate them to trades that are less extended, or whatever? So what is the answer to this question?
I mean, I would, almost all the time I would allocate it. I'm a little confused by your example, but I'll try to wade through this. And this is a great question. This is the second thing I wanted to talk about. But I would just spread it out amongst all the markets, all 300 markets. I'd put them on if I had if I put money in, or if another client put money in. I don't know why I would consider putting all of the money into orange juice when it's one of 300 positions. So this has got me a little baffled. I don't.
No, because your system is telling you should have this big position now in orange juice, and you should watch it.
No, it's not. That's part of your problem, is that it's not telling you that you should have that position in orange juice.
But you would have it if you traded it.
Well, I know. I mean, I know what I would have. You got to come up with something a little bit better than that. I mean, but let me finish my my comment here. And so, no, the system said buy orange juice a year ago. So I did not do that.
2 years ago.
Yeah, well, whatever. And I did not do that. So it's not telling me to buy orange juice now. So
but why are you holding orange juice now?
Oh, yeah, and I agree with that. That's another kind of market cliche that I don't agree with. You're getting into this cliche where it says, if you wouldn't own it today, you shouldn't have the position on. And
exactly.
Yeah, right. Well, that's bullshit. It's a cliche and it's wrong. And because I've already stated, look,
how is it wrong?
I've already stated how it's wrong. You accept that we disagree with this. It's wrong because the system told me to buy it 2 years ago. And I hold on to it because the system hasn't gotten out, and it's an open trade profit, and I let the profits run, and I have that same position on.
So you're telling me that at this point in orange juice, you don't have positive expectation for profits. That's why you wouldn't put money in it.
I know that if I hold on to that position and wait for my system exit to get me out, then that's going to maximize my profit in that particular trade.
Then put fresh money in.
No, because the the system called for me to put it in 2 years ago, not today. So I don't, and the fact that it's a profit and that I did the right trade 2 years ago and then I'm holding on to it today doesn't have anything to do with me predicting or me trying to anticipate the expectation of that trade from right now. That's information I don't have. I know the expectation of the trade 2 years ago and the expectation if I wait for my exit. But I don't know, I don't claim to know or care what the expectation is now from this point. Is it going to keep going up or down? I have no idea. So I don't care about that. I don't know that. That's not how it all works. And I think, yeah, I think that this is all part of following a system, and following a system. This is the very definition of it. I think that we've talked about this many times. That creating these extreme examples of how half of your net worth is going to go away, I'm totally fine, and I'm on the record as saying, look, if you want to get out of your position and take some profits off the table, this is something that people do, and they should. It's fine. I mean, if I felt like at some point in time, I had this huge net worth, and hanging on for more would not serve a good purpose, then I would just get out. I wouldn't kid myself that it's the right thing to do. And I think that on any one trade like this, you could make this discretionary move, and that's because that's how trend following works. It makes the most amount of money over all the trades, but it has no ability to help you on any individual trade. And I think if you're not, and then you can throw in these extra rules that are not robust because they have no sample size, because they're basically going to be written to say, if I have a big profit, do this. Well, by definition, if you have you don't have very many big profits. So you can't write a legitimate, robust rule. So you can become a rule follower and make yourself feel better that you have these rules, but this is what I call the systematized discretion. If I come in and if I follow my system 99.9% of the time, and I get out of this, a part of this trade to preserve half my net worth, a portion of my net worth, half of my net worth, then that's bogus. That's discretion. You shouldn't do that, Jerry. If I write the rule in the system, somehow magic occurs, and I have this non-robust rules that help me preserve this profit. It's just looking down the barrel of one entry, one exit, and a stop loss and saying, no, I am not going to follow that. I have seen examples where this is giving back too much money. So I'm going to layer on more of these rules that don't do that, so I can say to myself, it's systematic, I'm a rule follower, unlike you. And I'm just saying, that's bogus. Just get out of it, go back to following your system. It's a total discretionary move, whether it's a rule or not a rule, because there's no basis behind these rules that are based on large open profits.
But there are bases for these rules. And the sample size is plenty big. It's well beyond what's needed. And the rule is not to preserve your open profits. The rule that you apply, and you're applying risk sharing and risk pooling at all times. Any moment there is profit, there is equity. Your equity at all times is your money, because at all times you can close your book within 1 hour and all that cash that you see could be yours. So the fact that you're in positions means nothing. Your equity is what your equity is, and your goal is to maximize your expectation on your ensemble as a whole, to maximize your final net wealth. And my claim is that the more you are diversified, have diversified your whole equity across your whole ensemble of hopefully positive revenue streams with positive expectation, and well diversified and wide enough, your final net wealth will be bigger, and you will get to it smoother with less ulcers in your stomach. The goal is not to preserve the profits. Oh, I got profits, now I'm going out. I'm cutting my profits short. No, I'm not getting out to cut my profits short. I'm merely risk pooling, redistributing my equity at all times to maximize my expected final net wealth. That's the argument for doing what I'm proposed to do.
But I think inherent in that, I think I'm having to guess because your explanation is not sufficient. Is this idea that we're using current equity as to size trades, which we are not doing. And the fact of the matter is that this is exactly the reason we don't do what you're advocating. Is the computer says if you want to maximize your wealth, use a closed trade equity for your trade level and let the profits run unabated, unrestricted with the single trailing stop. That's why we do it. We're doing it because we're making more money by doing it this way, and with all these components, including the
we're making more money compared to what?
Compared to the amount that we risk. We make $3 for every dollar we risk.
Difference
absolute, Richard,
between your approach. Between your approach
to say everything I wish to answer the question, but the conversation went so interesting that I think I missed my train of thought here. But what I'd like to point is that, well, first your first question was if we had 50% of our net worth in open trade equity, and what would we do about that? I'd say that before we answer that question, we answer a lot of previous questions regarding the level of risk we are willing to implement or to employ in the systems we work. We are willing to take small losses. We are willing to take big wins. We're willing to take small wins, and we're willing to see big wins turn into small wins or small losses. If I'm comfortable with these facts or with these features of the systems, it doesn't really matter in the end if the 50% open equity in one trade will become close to nothing, or if it will become even a small loss. Because we, as Jerry said, we shouldn't care, or if we are trading these simple, quote-unquote, caveman trend following systems, we don't really care about the open equity. We don't really care about what the trade is doing while it is open. And then I was thinking about this distinction in the way we think absolute, because I think that if you are willing to run these caveman trend following systems, you have to take the time out of the equation. We don't really see or we shouldn't see what the performance day to day is. We don't really pay attention to the price action while the trade is on. We're just caring about if the stop was hit or if the trailing stop was hit, and that's enough. Because, as Jerry said, by our research, we found that this is we see that's the most secure way to win in the markets. And yeah, I think that's all I wish to say.
Absolutely. I think I like your question and the way you are framing the problem, but perhaps the biggest difference and almost irreconcilable is the fact that you are, and I am as well, for what it's worth, looking at wealth from a geometric average point of view. So you want to maximize your geometric return, and Jerry, Richard, most people on this space look at arithmetic returns. So we care about the portfolio of trades. They care about maximizing each individual trade, and the portfolio is just a sum of line items. So I think that's why Jerry tells you that what he does is the best because his optimization target is slightly different than the way we specify our objective function. So in that sense, I don't think you could find an optimal solution because, it's almost two different problems. I mean, I agree there are not very big differences, but procedurally, this small difference at the outset translates into behaving differently towards open profits. In our case, open profits fold into the equity because it's the money we have. And your example is quite striking in proving that. In that case, they're just saying, well, it doesn't matter because today I wouldn't put on this big orange juice trade. Look, my ATRs.
Yeah, I can hear you. We lost Bruno.
Yeah, we lost Bruno. Yeah, until Bruno gets back, I was just going to say that I was just so totally. I think one of the things I remember about 2022 so much is how I came to understand so many of the managed futures CTAs are looking at this from your point of view, and with Harold on there talking about not following the rules so much, and everything is a portfolio, and not taking small losses if the losses in some markets were offset by gains in other markets. And it's really has evolved into some sort of trend-influenced portfolio asset allocation models to some degree. The whole idea of, just like Bruno said, we buy here, sell there in 300 markets, and then we act like there is nothing else going on except this one market. And then at the end of the day, we add them all up as if they're 300 independent investments. Oops, that's our portfolio. We care nothing about managing that portfolio and increasing leverage, decreasing leverage, and paying attention to correlation or smoothing things at all. It's 300 individual trades that are handled the exact same way with this one entry, one exit, and a stop loss. And yet, this is, I think, the majority of the CTAs. They need to do their own spaces so they can talk to us all about this so we can hear more. But I was just shocked at how, I know Dunn does this, Niels has been talking about this for years, and the Harold Top Traders Unplugged interview was pretty fascinating in that the way he described, how they do things. And to some degree, like Neil said, I don't think that the performance differences are great amongst a lot of those CTAs. I think because they're all kind of doing the same thing, cutting profits short, smoothing things out. But I do think in the long run, if you get a 5 or 10% of these outliers, I think, and we hold on to them like Richard and I will do, I think you'll start to see some differences in performance. He's basically comparing a whole industry that doesn't let profits run and saying, I don't see much different if you trade 50 markets or 500. And I've told him a million times, I agree, because they're cutting profits short. They're keeping things smooth. They're participating in the outliers at much reduced levels compared to Richard and me.
I hope you're all doing fine. Just coming back on the orange juice position, I'd like to ask you a question, and you can tell me if I sinned a little or whether everything I did with that orange juice position is all right. So I look at the portfolio, and every day I have the distance of my position to my exit level measured in ATRs, and with the move that we've seen in orange juice is at the top of the list. It's about 12 ATRs away from the exit. I have a bunch of other positions like long soybean meal, which is 11 ATRs away, and what else? Yeah, a bunch of things that are fairly distant, but OJ's out there.
Current ATRs or original ATRs?
No, I use original ATRs.
That sounds low.
No, hang on. No, you mean to the distance to the exit level right now is in current ATRs, the most recent 20-day average true range.
Right. So that's what I was saying. If it was original ATR,
no, because the original ATR is very small. When I got into orange juice, I got into
It's a pretty scary trade.
I got into orange juice on I got into orange juice in June, the 1st of June 2022. So here's what I did. I only have 2 contracts on, and I looked at my roll schedule, and I know that orange juice is coming up for a roll in 16 days. I rolled it at the end of the month. I rolled from March into May, and I had a look at the spread market, so March minus May, and what you see there is, it's trading at around 20, and that spread has widened significantly because, March is outperforming the rest of the OJ curve because all the stress is on the March contract. So I don't want to predict anything. I don't want to say that the March contract has no more juice in it. The thing may go to 300, and therefore I don't want to exit my March position because that's where the music plays right now. But because I have more than one contract, I can, and this maybe is my sin, I'd like to have your feedback on this. I can roll one contract out of the 2 prematurely into May because the May contract hasn't rallied as much. So I'm essentially selling the spread at what looks like, and I could be wrong on this, a relatively elevated level. But I'm still exposed to March, just not as much as I used to be. I'm also a little bit exposed to May now. And that is essentially one way for me to react to that move and essentially reduce a little bit of delta that I have on the March contract where a lot of the profits have accrued. Whether that's sinning or not, I don't know. It is a confession. I did it. And I sometimes do this.
Yeah, right. I mean, I think it's not a big deal. And although I do remember that heating oil trade, some of these trades like heating oil, in the commodities, the agriculturals, it will be sort of centered in 1 month. And those spreads can get even wider. So, I mean, that's just kind of the risk that, it's kind of a counter trend move. I've made a lot of money over the years doing the opposite, just pushing it, trying to stay in that front month as long as possible because it was so much stronger in the uptrends. And even I think we did some downtrends that way. The first natural gas trade back in the 90s or whatever, I think we tried to stay in that front month as long as we possibly could. It was, so I have a tendency to just trend follow the spreads as well. And it just can become a mess, like you said. But, and one of the things that Absolute said, which maybe misspoke a bit, was giving this impression that it was, that orange juice was going to collapse. But there is no evidence of that it's going to collapse. There is no evidence that you're going to use it all back. You have no evidence that, the evidence that you have is to stay in that trend until your exit gets hit. That's the only evidence you have. And you know that if you do that every single time for the rest of your life, you will make the most amount of money. You can't improve upon these systems by adding additional features to them. But they do claim to improve them because they have to revert back to Sharp. Yes, you can add a lot of crap to your one entry, one exit, and a stop loss and totally justify it if you use Sharp and if you use current AUM as a baseline and to size trades. And then we come up with this much superior algorithm that separates the equity and preserves the capital because the computer says, let the profits run. You cannot, if you use current AUM, you're putting yourself into this really bad situation. And you must do bad things later because you're doing wrong things initially. And so I don't do wrong things initially. I use my closed trade equity. I defend that equity. I can balls to the walls on the open trade profit, trade larger, let profits run, accept more drawdown on the open trades, which is not that volatility and drawdown in the up in trades is not risk, it's following the system. And I'm very able to, once I segregate and I'm very conscious of my closed trade equity, I'm able to preserve that capital and then over time ratchet up my trade level as my closed trade equity increases. But yeah, if you're doing something wrong at the very beginning, yeah, damn right, you better vol manage, correlation manage, you better do something because you're making a tremendous mistake by using current AUM to size your positions. But all they have going for them, you will not hear one CTA, one manager talk one lick about all the things that they do, all the stuff they've added to the trend following. In the same breath, they have to mention volatility and sharp. That's how they justify. And it's it's 1,000% taking profits. It's pretend risk management because they're not dumber than I am. They know better. And it's kind of what clients want.
I want to say that if we do so, was very impressed when Richard said in one of the recent episodes of Talk to Traders Unplugged, that we need an asymmetrical decision in non-linear world. So if we do something that adds such smoothness, like Richard also said, there's sharp shows smoothness, but in fact it shows nothing. In non-linear world, it's not it's a dynamic system. It's not a static system. So we can see very different things in the market, and a lot of recent 2 years we have seen very different things in the market, and we have seen how our trend following algorithms, our systems, how it dealt with this in a very good way. And we have seen this total unpredictable things we have seen. And I fully agree with Jerry, and I fully agree with Richard here that we don't need something that make us more smooth, because in the end of the day we will lose money because of this. And it's not good. We must think, I think, in every business, in every very important thing.
Richard, you're awfully quiet.
No, Jerry, just listening, just enjoying the conversation. Look, all I'd say is that this hypothetical example that Absolute gave is basically saying it's questioning our practice of using realized balance as opposed to equity in our allocation. And we've given lots of reasons why we do it, and I think we just accept the fact that we do it that way. I can see where the angle he's coming from and what Bruno P was saying, but I disagree with Bruno P in him saying that we're interested in the arithmetic mean as opposed to the geometric mean. I actually totally disagree with that principle. I think we are striking for KGAR, optimal KGAR with our approach. I gave a couple of examples this week of an approach that, using a process that, generates this optimal asymmetry before we even look at considering things like position sizing or leverage. I think in our game, Jerry, where we're specifically hunting for outliers, and this sets us apart from all of the things we've been hearing on TTU these days. Row asset management, they're a multi-strat manager. They think they know what trend is. Crable, the ones I really liked was Harold, but then after that, as I sort of listened to more and more from Crable, Row, I haven't listened to the Dunn one lately, but I realise how different they are to us, and that they're striking things from a much more multi-strat position. And I think, I've said numerous times before, I think that is almost getting less divergent from what we're doing. So there is a particular approach we apply because we know the capabilities of these outliers in their ability to deliver this optimal asymmetry. What that means to us, therefore, is that, the example given by Absolute of 50%, if, for instance, we said, all right, you're right, and, the optimal allocation is to invest at any point in our equity optimally at all points in time, then the argument becomes, well, do you do it at 30%? Do you do it at 20%? Do you do it at 10%? And really, the argument's saying, yes, you should be doing it 10% or 5%. And then what you're actually doing is you're flattening your equity curve and you're removing your ability to really harvest the capabilities of these outliers. So, I think it's predominantly because our focus is focused towards these outliers is the reasons for why we approach our problem this way. I recognize that other trend followers do things differently, and there's no problems with that. However, I don't think that is compromising our ability to generate CAGR like Bruno P might have been suggesting. I think in our world of outliers, it actually increases our ability to generate CAGR under maximum diversification.
For example, if you get into a fund, I mean, this makes sense if you're managing your own money, or I don't know, a managed account, etc. But if you're going into a fund, right? Aren't you buying the business of the fund, so to speak, at the moment? I mean, if you get money into the fund, then the fund will make its orange juice position bigger and all their other positions bigger. The same way, like, for example, if you invest in Amazon today, you are investing in the AWS business as it's mature today. And so doesn't it make a difference the way that you are making this? Because if you're making it with your own money, then you can wait, so, I mean, if you enter a hedge fund today, you're kind of using the open equity of your money because you are buying the strategy as a business. Isn't that so? Or maybe I'm incorrect.
No, you're exactly right, Cordura. There's a business of trend following and there's the trading of trend following. I'm in the camp of trading trend following because I think you compromise these abilities when you focus on the business of trend following. So the business of trend following is good in raising AUM, giving flatness, giving investors confidence, all of these things. You're aligning your technique to the psychology of your investors. Personally, I don't think we can trade trend following that way. I think that we've got to recognise we live in a school of hard knocks, and our earn is from the difficulty of generating alpha with our patient approach. But that's where the alpha exists. So, a compromise to that is what I think these other trend followers are doing, simply because it's good to be in business to raise AUM and get the management fee and performance fees. But I don't, I ethically think that compromises our ability to generate absolute returns when we are targeting outliers.
So I'm hearing this argument a lot of times that the classical trend followers don't care about smoothness. They go for maximum CAGR and maximum amount of money they can make, whereas the funds or traders who care about smoothness, they do so just to placate investors, and they're after their fees, management fees and performance fees, and they don't care about performance. I disagree with that, and I claim that with my smoother curve, I can let it rip. I mean, I can make 45% a year with 25% drawdown or volatility. That's why big funds are shooting for 10% vol or 10% return is because they're big, and it's because their clients usually cannot handle more than 10% or 15% drawdown. So they're shooting for a wider audience. And when you go for wider audience, it's harder and harder to find people or assets or capital that can stomach 30 or 34, 35 or 40% drawdowns. So the big funds, so you can do 10% or 15% or 40% drawdown, regardless of how smooth your returns are. So your MAR and Sharp could be 0.5, and you can still size your strategy to go for 10% drawdown and make 6 or 7% a year or 5% a year. If your clients say that, hey, 10% is where my ulcers in the stomach start to go, and don't go more than 10%. Okay, and then you'll tell them, listen, my edge is 0.5 sharp and 0.5 mar. That's my edge. If you're telling me that 10% is big drawdown or a big standard deviation for you, then I'm promising you 5% return a year. Are you okay with that? I'm okay. Then let's go. I'll charge you 2% and 20%, and then we'll go. And then they'll get our assets. That same person with 0.5 sharp and mar can also find a client who will say, hey, are you ready to go with 40% drawdown? And he say, yes, with this money that I'm giving you, which is much less than the amount of money that I can give somebody for a 10% drawdown. This is my risk capital. My wife says she doesn't care if we lose it. Here it is. Let it rip with 40% drawdown. And what's the return I'm expecting to get? Well, then you can expect 20% return. And you can let it rip with 0.5. You can do the same math and the same analogy with a smoother return, with strategy with 1.5 sharp or 1.5 mar. So you can have these agreements with your clients with 0.5 mar or sharp or 1.5 mar or sharp. It's how much drawdown and how much volatility they can take. And then you go back to your lab, you size your strategy for that amount of drawdown and volatility. And then you tell them how much return you can deliver for that. So what I'm saying is, what I don't agree with is that the implication is that funds go for smoothness just for AUM. No. Funds, and I myself, I like smoothness. I like higher mar. I like higher sharp for myself, not for clients. And there are clients also who would prefer higher mar and higher sharp as long as it's robust. I understand how higher sharp and higher mar could imply overfitting and curve fitting, because in 99% of the cases, when somebody shows you a curve with sharp of 2 or 3 or 4, it's usually an overfit bullshit. And most people think, then extrapolate, oh, well, then low mar and low sharp means robustness, high mar and high sharp means overfit. But for somebody who knows what they're doing and know what's robust and what's not, getting higher mar and higher sharp is beneficial. And why it's beneficial? It's because it will maximize your KGAR and final wealth per unit of risk, of ruin. So that's my argument. And why I would like to diversify the 5 million in an open trade. Okay, then also I just wanted to mention, look at it from a perspective of opportunity cost. The 5 million, in my case, in my example, that's sitting in orange juice right now, ready to be either lost, or let's say you don't even lose it. It kind of sits there, up there, and orange juice just stays there for a year, and all your trailing stop approach, and then you kind of capture your trade and you finish your trade. You just spent 1 full year holding 5 million of your money, of your equity, 50% of your net worth, and you lost 1 year of distributing it to your ensemble, which over 30 or 40 years has shown it can make you 44, 45% a year or 40% a year. You just did not invest them. They were just sleeping there in orange juice. Sitting there in one concentrated part of your ensemble is not the optimal place for you. So that there's an opportunity cost. I understand that because of discipline and ideology, this is what you have to do, because I don't want.
Yeah, but also there's a type
rules.
2 error. Absolute. There's a type 2 error if you take if you reduce that 50% allocation to invest elsewhere optimally. That's a type 2 error for me.
No,
so that's why I don't do it.
If you have a system, I'm by all means follow your system. And I would say my answer would be no. I would leave it in orange juice. I agree that. So by all means, do not take money out of your system and distribute it to your ensemble or whatever. I'm not suggesting you do that. But I said I put that example to make my point about risk pooling, risk sharing, and about an opportunity cost of not doing so. Because if you have an ensemble, a wide ensemble of strategies and markets over which it's applied, and let's say 100 markets and then 50 strategies, 100 times 50, that's 5,000. You have a wide ensemble of strategies and markets, which you have built it. They're all good. You've picked them. They're robust. You've tested them, and they're all available to you. Keeping half of your net worth in just very narrow part of that ensemble actually cost you a lot in terms of opportunity. Even if it doesn't immediately come back and you lose them all, even if they sit there in orange juice as your trailing stop approach. So this is why I think you're saying it's type 2 error. I don't think it's type 2 error. Trying to risk pool and risk share to maximize your allocation of your equity as it is across your whole ensemble of 5,000 revenue streams is what will maximize your KGAR and your final net worth with the minimum amount of risk reward. That's my argument.
Yeah, but and this is where I'd slightly disagree with you, absolutely, because I believe it's where the outliers occur that maximizes my KGAR. It's not the optimal allocation at all points in time across my portfolio. This opportunity cost you're talking about, I'm saying, well, actually, I don't see an opportunity cost there because I'm on an outlier now. It's unrealized profit. This is one outlier. I don't get many of them, but they do occur with, quite considerable frequency across my portfolio. I don't know where the next one's going to come. I'm taking maximum opportunity with this outlier, fully invested with my systems. So I don't view that as an opportunity cost. I view that as, the optimal allocation of my capital at that point in time to my portfolio.
Okay, so if it's optimal, now you're suffering from cognitive dissonance. If it's the optimum allocation of capital at that moment in time, then you would put the fresh 5 million of cash all in orange juice, which nobody of you said would do.
No, I'm committed. I've been committed since 2019 on orange juice. So
no. Would you put fresh 5 million now into the trade right now, fresh?
The reason why I was hesitant to respond to your tweets is because I smelt the trap lying around it, which is the classic trap that I believe that most people fall into. No, they fall into it because there's this statistical reasoning, assuming that there's some optimal allocated portfolio, which I think is a load of BS. In my hunt for outliers, I'm using a portfolio to capture these outliers. It's not any form of optimal allocation. I'm not using any form of position sizing to capture them apart from weak compounding. That's all I'm doing. I'm using my small bets, each individual small bet. There is no optimal allocation of those bets. There's no greater bet or smaller bet per market because of, this optimal approach to maximizing a theoretical expected return, which I never know exists. So this is my whole argument. Right? It's not so cut and dried.
Yeah, the thing is that trend following, the way we do is completely time dependent. Not time dependent. What I'm trying to say is that the way we do is that we wish to go with the trend from the beginning, from when our system instructs us to do so, and we will be out when the system instructs us to do so. If we're in the middle of the trend, if by for instance you start your trend following program right now, while the trend in OJ has already begun and you're in the middle of it. The most ideologue way to approach this, the most conservative way to approach this is don't go in at all. Wait for the next interest signal for you to go in. The most, for lack of a better word, reckless way to do this is go in with it all. Pretend you were on this trend from the beginning, and you're hoping for the trend to continue to go up. But we don't have any information if that's going to be the case. We don't have any information at all. So it's basically a non-system trend to get in right now.
But Bruno, what kind of information is it that you bought it 2 years ago? You would have bought it 2 years ago. If you bought it 2 years ago, then it's more likely to go up. Whereas if you have cash and you didn't buy it 2 years ago, you don't know whether it's more likely to go up. It makes no sense. Yeah. It makes no sense.
Okay, I think it does. What I'm saying is that the way we calculate our trade stats and the way we approach markets and the way we interpret this whole thing is that we have a really bad system in the way that it doesn't give us a lot of information. It gives us really crude information, and that's just barely enough for it to approach the markets. And we wish to stay that way to completely avoid overfit, to be as far from overfit as possible. So what we have with this system is that we have one entry signal, we have one exit signal, and that's it. Oh, what you do in the middle of it, I have no idea at all.
Oh,
That's how I view it, Bruno.
I was just going to say that I do understand now the part I was confused about redistributing the 5 million. I understand that now. So I do think that two things. One is using open trade equity, like that 5 million example, as part of the trade level and redistributing it to trade larger can also create bigger losses as well. So it's not just a one-way street. And another thing that is missing is that, not missing from, because I say the same things almost on every call. And so my memory's bad, but you guys got to do better because I repeat myself every week. And that is, we trade a bigger unit size. So we're not just reducing this trade level and sitting there and missing out on profits because we have this artificially low trade level. It is, the computer says, dude, if you're going to use this artificially low, I'm artificially in quotes, it's not what everyone else uses, current AUM or something like that, then you're not going to make much money. So your risk budget needs to be higher. So offset this conservative trade level with higher unit sizes, more risk per trade. Well, why would you do that? Why do you make that choice? Once again, every week we say the same thing, consistency. We want to treat all the trades the same for the rest of our life. So we want to have that constant unit size. And and me personally, I want to try to keep that trade level the same for a while. It's not just how the trade level is calculated with the closed trade equity. It is combined with keep it similar for a while. And with my systems that have an average holding period of a year, I'm not booking these trades that often, so I am kind of able to keep that trade level. So when you multiply the two, your trade level times your unit size, my trade level times my unit size, those numbers could be the exact same. It's just a question of you're changing your trade level every day. I'm changing my trade level infrequent, and I'm keeping my unit sizes the same. So I'm committed to this consistency. One entry, one exit, a stop loss, every single trade for the rest of my life. I'd like to have a constant trade level, but that would mean I'd have to distribute all the profits at the end of the year. And I'm in business and I want to keep some of those profits and trade them and make more money. And I think it's more beneficial to think of this strategy as an algorithm and not a philosophy. You're upset by this philosophy. Why are you doing this thing? And I've said before, if Richard and I would have never talked about this in English and it was just an algorithm. And so the algorithm is superior. And you're focusing on our philosophy. It's not a philosophy. It's an algorithm. And I haven't even gotten into this whole idea that this is a pretty remarkable thing that the closed trade equity drawdowns are always exceeded by the open trade equity. Every single day after the first 6 months or a year of trading on the back test with these systems, the closed trade equity drawdown, what we're trying to preserve, and we're very interested in preserving it, trading lots of markets, small bets, it's always, that drawdown is always exceeded by open trade equity. So we could essentially trade tremendously large if we weren't afraid of the future. We could trade larger than anyone based upon the back test, because we never had even a drawdown in our closed trade equity if you add in the open trade equity. And then I think that Absolute hit the nail on the head at the very end. Yes, and that is that we just have different respect for the relying upon the back test and adding more rules and more conditions on how to hunt these outliers based upon the patterns of the past. That's something I think that to some degree, something that's not over-optimized can still, in some sort of math definition of being over-optimized, it can still have something way less than loose pants.
Can I just, yes, I mean, I agree. So we differ in philosophy. Bruno, to comment on your thing that you admitted that orange juice would still have some statistical advantage, but you don't know how about me. That's why you're long. You think it's gonna more likely to go up than not, because you're still not stopped out. Your system is still holding it. And my comment on it is that yes, there is always statistical edge. If orange juice is up so much, it's more likely to go up. But my position in it will reflect the size of that expectation, and I will size it accordingly. I will not allow a decision I've made 2 years ago, which has nothing to do with the present, to concentrate 50% of my net worth in 5% of my ensemble because of a small statistical advantage. That's the whole point of risk sharing and risk pooling. At all times, all your bets should reflect your expectation. And I agree. I'm also long orange juice. But the size of my bet in orange juice reflects the expectation of it to continue to go up, as is the other 5,000 members of my ensemble in my 100 markets. So at all times, the size of my bets reflects the expectation for them to go in a certain direction. That's all I'm trying to do. And you can do that in a very simple and robust way. And there are ways to show and prove robustness. I mean, for some people who have been in the business for 20, 25 years, like if I have a method, if I can throw my method over 50 completely unknown markets and it adapts, it does its job, then I throw it again to 50 other markets or out of sample or in different unknown things just for the kicks, not because they're tradable or whatever. There are ways to prove robustness. And in terms of implying that, again, there are ways to achieve higher MAR and higher Sharpe without overfitting. Anybody who's in this business and survived 10 years have to learn about overfitting. I don't think anybody can survive even 5 years without knowing about overfitting. So I think I learned about overfitting maybe in my first 3 years. That was more than 25 years ago. And then I learned more and more and more. I don't want to go into too much detail. But what I'm saying is the argument that I'm trying to make comes from a different angle, and I hope you consider it.
So, I mean, just to say something about this overfitting.
I think the...
Go ahead, Bruno.
Okay, go on, Alp.
I mean, the overfitting part...
really quick here. I think the... No, really quick here. I think it is fundamentally a philosophical difference here, because we are following our algorithm and Absolute is following his. What I get from our conversation is that whereas Absolute is afraid of overfitting and try to minimize it, we are terrified of it, and we use even less parameters, and we approach the markets in a even more modest with a set of rules, perhaps. But yeah, I get it completely. I understand that there is room to be more fit and not so underfit as we are. I just couldn't figure out a safe way to do so. And more than that, I wonder if is it if is it worth it? You know, if how much more am I going to earn from a CAGR perspective, having more complex rules, whereas simple rules that are definitely more robust.
Yes, I would argue I have less than 3 parameters, and I can't say more without disclosing too much. So
Yes.
Oh, I'm taking notes. Absolutely.
I mean, so you're gonna avoid the overfitting, right? And the overfitting is very easy to do if you are, coding your own algorithm, because it's easy to actually optimize something according to the data, and then when the data changes, hooray, that wouldn't help you out so much. So, and the number of, the only point of this dynamic position sizing in that using that way is just an additional parameter. It's just an additional angle to think about that. And so definitely I agree with the conversation in the sense that the minimum number of parameters is required. So, one entry, one exit, one stop, and possibly a filter or two if you wanted to do anything else. But apart from that, if you want to, especially this is a challenge, last week when we were talking about Richard's adjusting the systems every year, you end up with new positions every year. So, if you're not careful, you would want to enter into those positions at the end of every year. And that, or, someone else like me, when I start trading, this is my second year, what happens is, you change your system and you end up with a new open position that you're not participating in. And it is very tempting to get in the middle of it and to take the trade. So it requires a lot of discipline not to do it and not to take the trade and just wait the new signal to come in, actually. And that requires discipline, and this requires internal control, and this requires just to stick into your system and the set of rules, really. So I don't see, any argument in jumping into an orange juice trade or any trade in the middle of the trend. Who would do that? I wouldn't, surely. Thanks.
Hi there. Could I just ask, Absolute, is so when you have that risk on that 50% of your net worth already on, are you saying that there's a new signal that your system is giving you, which is why you're saying that you'd want to get into more, or I wasn't quite sure.
No, my algorithm is completely different from what's being discussed here from Jerry or Richard. So my algorithm optimizes allocation of current equity across the whole ensemble at all times. So at any moment, like today, I can just completely switch it off, rest for 2 days, and 2 days later, I want to put my money back in. I'll put them in wherever my system tells me to. I'm not going to ask how far OJ has run or whatever. I'm just going to put all the positions on without worrying that, OJ may be extended. And if I put my position now in OJ, I'll be risking 50% of my net worth, because that will never happen if you consistently risk pool and risk share available equity.
Can I make a plug for a book here, Jerry?
Please.
There's a magnificent book written by Mitchell Waldrop called Complexity, The Emerging Science at the Edge of Order and Chaos. If you're a trend follower, I'd really recommend having a good read of that. It is fascinating, and it sort of it showcases the change in economics that started emerging from 1980s up to the current day, where they started really challenging the efficient markets hypothesis, where a lot of work was done at the Santa Fe Institute through a collaboration of a lot of different scientists from different professions who sort of all collectively got together to look at these complex adaptive systems and look at some of the rules that emerge from there that are totally against some of the principal foundations of economics. And it's just a fantastic book, and a really good plug there. So yeah, get your hands on it if you can. Have a good read.
Yeah, Richard, that book sounds familiar. Can you? I think I may have. This is probably old. It's probably more than 20 years ago, at least, right?
Yeah, it's quite old. It's sort of it's probably about 10 or 15,
Okay.
but it starts sort of from about the 1980s, where the likes of
Okay.
Brian Arthur and
Can you
a
tweet
few of these
that?
people.
Can
Yeah,
you
I'll
tweet the
put it
name
on.
of it when on the group after the
I
stream?
will.
Yeah.
Yep, definitely.
Thanks.
Richard, I was thinking when I talked at the beginning of the conversation on about how do you manage different equities for different systems, etc. And I was thinking about it on a very technical level. And I remember you because you said that when you optimize every year and you add information every year, you have to keep track of which trade was open on which version of your parameters, right? So that must be a very, very hard and high maintenance task to do, right? I guess if you use closed equity, it will be easier because you don't have to link it to to fit to a number that changes every day, but still must be a very hard thing on the on the technical side.
No, look, it's not that hard. So if you can imagine, let's say in 2022, I've basically got a CSV file of all of my systems, and that CSV file is instructing the portfolio algorithm to take trades. And so in that CSV file, there's a column there that just says, don't allow that particular system to take any future trades. So when you set that to false, for all of your trades, all that means is it allows your existing trades that are open to play out, but it won't take any new trades. And then what you do is you just append the new generation of systems onto that CSV file, and the portfolio algorithm just basically then takes the instruction of the new systems and plays out the old systems. So it's a pretty simple process, thanks to Fred, the programmer who works with me. He sort of developed it this way, but and also I definitely. Whenever I'm particularly in a single month, I'm trading a fixed level of dollar risk per trade, and at the end of a period of time, I will then make an assessment whether I need to lift that. And so I'm applying a very weak form of compounding. So it really doesn't get that complicated when I know where I'm at in my process.
And so when the trades are open, do they like travel with their own parameters when they are open, or just at the beginning when they are when they are open, or just when you open them?
Yeah, so the parameters are all baked in from entry, and they stay that way. So the variables all stay constant when that trade following entry, right up until exit. They're always constant, because I deal in terms of ATR based normalization methods. So I've got an ATR based multiple applied to my stops and my trailing stops. It's all sort of regimented and static in terms of the variables. Of course, the ATR does vary, but because I'm using a 25 period ATR, but the multiple stays the same. It's fairly static. So that just stays in place until the trade is exited, and then when the new system comes in, it takes over. But each generation of new systems. So 2023, I got 15 systems across 70 markets. But if you look closely at a lot of those systems, you'll find a lot of them are sharing similar properties to what they were in 2022. There isn't much variation there, but it's not a sort of like a 1 unit variation on each of the variables. I use these sort of much larger incremental variations for my strategies. So they tend to stay fairly similar unless something significant has happened during the year, which has changed the nature of trends or added to the history of the data set. And then there'll be a greater variation in the variables chosen the next year for those particular models.
And you use that equity level that you change every now and then. You use it. They all of them use the same number as an input, right? Even maybe you rebalance them between the systems or not, but they use just one number.
That's correct. So there's a fixed dollar risk assigned to trade entry at all times. But, after 6 months, you might find that you lift your dollar risk to say, let's say I was trading $500 risk per trade. And then 6 months later, I decide that my equities, my realized balance is considerably lifted. And now I want a weekly compound. So I might go to $700 per trade in equity. Let's say, for example, at the point of doing the 700, any new trades that come on get the 700 application, but those that are already alive with the $500 application don't get changed. They stay on the 500. Does that make sense?
Yeah, thank you.
So I wanted to, 3 questions here I wanted to ask the group. I've asked these on Twitter before and in these spaces, and it's just 3 rude questions I came up with to make fun of the people who don't do things the way I do it. And then I posted one of these questions on Twitter, and the answers were the comments were so ridiculous. And I know no one wants to answer these questions, and that's exactly what happened, because you could step in it if you answer these questions the wrong way. And this is just the distance. This is just my opinion about how far away managers are, managed future CTAs are from reality. Their numbers and their programs, they're not, it's so different from what's happening in the real world. None of these formulas translate into real risk. All right, first question. Please, let's just answer the questions, Don't ask me, this is overfit, come on, I understand that. This is just, we're having fun here. Okay. If you had a system that if you followed it and you never had a losing trade, do you think you would pay attention to volatility? Do you think you would need to? Do you think the clients would or should pay attention to your system that if you followed it to a T, it never had a losing trade? It didn't have big losers. It's not overfit. It's just a stupid question. Okay, go with it. Number 2, if you guaranteed to your clients that you would always guarantee that you would return to them whenever they wanted it, their initial capital and all realized profits, should the clients care about vol? Would you care? Should they care? And that's parenthetically, it's exactly what we do. We, on the back test, okay, it's not the same as guaranteeing, but on the back test, we can liquidate the position every single day of the 30, 40, 50-year back test and always have the capital and return the capital and the realized profits. Third question. Now, I asked this one a few weeks ago or maybe even last week. This is, I think, the problem. All drawdowns are not the same. They're treated like they're the same. A 5% drawdown, you ask any normal client, what do you prefer? 5% drawdown from your initial investment or a 20% drawdown, but you're still up 20% for the year, 20% from your initial investments. This is the problem. These ratios treat these drawdowns all the same. And what we're saying is they're not all the same. We're here to protect the capital, put us in a situation where we can legitimately follow these systems and let the profits run, no matter how scary, no matter how many millions is at risk. That's the key for future success.
Okay, Jerry, can I answer the questions? So
I hope so. I hope you can answer them correctly.
Okay. Yeah, the answer to the first one is yes, I would trade it. The second question was, what was it? Would you care if...
Okay, so the first question is, if you never had a losing trade in a system, as long as you followed it, would you still pay attention to volatility and be worried about it and say, essentially, I would rather have some losing trades in order to have more smoothness. And you're essentially saying is 100% winning trades is not a good measure of riskiness. Oh my God.
So I would have to know a little bit more about the process because there's a lot of convergent systems like selling options and selling premium, which are close to 100% winners and sharp of 6 equity curves, which, all your trades could be winning as long as you martingale into it, and then you can lose a lot. But listen, in the backtest, all trades are winning as long as you double down on your losing. You'll never lose money if you have infinite amount. So there are systems like that. So my answer is depends.
Right. So stop. Okay. This is exactly what I made fun of. Exactly. This is what I made fun of. These were the type of responses I was getting. They cannot answer the question. They cannot answer because they know what comes next. 90%, 50%, 40%. Once you dip your toe out of that cult of paying attention to Sharp and Vol and using your current AUM, and that's the reason that these objections, even though I warned and said, do not bring up these objections. Do not bring up these objections. This is a pretend game. Everyone knows what you're saying. Everybody knows these objections. We know this is not real world, but you still cannot answer the question because you know it's a house of cards.
Listen, I get your point. And my argument, my answer to that is, in order to do that, the opportunity cost, the amount of opportunity cost of locked in capital into small segments of your ensemble is so big that I can probably replicate the same CAGR and the same final wealth with smoother returns by reallocating and risk sharing, risk pooling, and using that capital more opportunistically. And I don't have to have the volatility. I'll just have the same return. And if that's the case, let's say we're both managing 10 million. You do it your way, I'll do it my way. I can always move 7 million on the side and keep it in cash and rip it with the 3 million. Like, let's say I have a Sharp of 1 or a Mar of 1, put it 50% drawdown and 50% compounding. That 3 million with 50% compounding can quickly overtake 10 million. And then I'll promise this to my investors. Listen, give me 10 million. I'll guarantee to give you 7 back, right? Or 9 back, or whatever. Let's say I'll give 9 back. So you only risk 1. With 1 million, with 50% compounding, 50% drawdown, in 5 years, I'll be like at 15, 20 million anyway. And I'll guarantee them that their 9 million will not be touched. I can replicate your promise and your bet with what I'm doing. I don't have to do what you're doing.
Yeah, well, there's our difference, that I have to do what I'm doing, and you're better, so you don't have to do what I'm doing. But what we're doing is good, and it suits our capabilities, I guess. So yeah, that's that's fine. But I do think that the answer to all these questions is obvious, and they throw a wrench into the formulas that people use to measure risk. A 5% drawdown on an open trade on initial capital is way worse to most people than a 20% drawdown. And that, this is what these ratios and the way of evaluating management.
This is beautiful.
What's kind of crazy is that we have dug down deep into the mechanics of how our systems work and how trend following works. And we've come up with this great way of looking at risk, and at the same time realizing the most important thing is to follow the system, and being able to follow that system and let it and maximize those profits at the same time preserving capital. And just because we are using numbers that are hidden that you have to go dig for, and that majority or almost all of the risk measurements are things that they're not valid unless you can pull it off the performance table. I mean, I think that's kind of crazy.
Yeah, Jerry, I just wanted to comment on this space, especially today. It was like a fencing match. I thought I asked questions that are going to corner you guys into a corner, and now you are asking questions that are cornering me into a corner. It's just beautiful.
I warned you this would happen, Absolute. I actually put up the Anchorman sort of series where, Channel 9 News was versing Spanish News was versing this. This is what happens in this forum.
Oh, yeah, well, it's all fun. And please, no one take offense, because every time I stop saying something, when I mute myself, I'm like laughing because I'm having a good time. And I'm not going to be able to argue. I'm not going to pretend I can argue against someone saying, "Hey, stop! I could figure out a better way of doing this." I mean, great. What can I say? Our way of doing things is on the table, and we're supposed to disagree with things we have no clue as what you're actually doing. So I do think you ignore some key points of what I say. It's just you can ignore it if you want to. It's just limits the ability to debate. I've said many times that we make up for this the issue you have with us not using AUM and not spreading that AUM more frequently over all the positions by trading larger on the unit size. That's valid, but it's you repeat what we do often and you leave out certain things that we do.
No, it's all fair. I mean, I understand. You opened my eyes to some concept that I wasn't aware of, and I'm also in awe as to, especially the division as an open and how you handle it. There's a lot to it, and actually, I'm jealous that you're in such a small minority in the business. So, just to be honest.
Well, I had nothing to talk about an hour and 45 minutes ago. This has flown by. Okay, does anybody want to bring up a different subject? Or does someone in the audience want to join the group of speakers? Let me know. Richard, I wanted to ask you if you're able to talk. What were you thinking when you were listening to Harold? I can't remember exactly what he meant by sort of belittling following rules, like you're following these rules and these rules are old. Why are you following these rules? And then this sort of portfolio way that people are handling things. Dunn does it. It's really interesting, and I'm so happy to be in sort of a trading minority that still pays attention to each individual trade, handling them correctly, and trying not to do too much on the portfolio side. If you have to get into your portfolio and scale it back, scale it up, reduce positions to preserve equity, it's kind of a system failure, which we're going to have sometimes. You can't shy away from it. But it is very interesting how trend is being combined with things people learn in business school and doctoral programs, and trend following. I mean, I think it might go away one of these days.
Yeah, look, I'm fascinated with people's different perspectives of what happens at the portfolio level versus what happens at the trade level. I think we've got a particular approach that is dedicated to this principle of uncertainty. I think our approach is working on the foundational principle that markets, there is no information is not disseminated in a diffuse manner universally across a market. There are areas in a market that are very uncertain. There are other areas in the market that are very certain. There's this almost these chaotic kernels that exist in the market. We're exploiting those chaotic kernels in the market. In the Cauchy distribution, at our portfolio level, what we're seeking to do is to mimic the properties of the tail regions of the distribution of returns, which is different to what a lot of other trend followers are doing. They're capturing different types of trend that exist in different areas of the distribution. I think our dedicated focus towards outliers is a unique quality, and that's why only a very small handful are focusing on that, Jerry. So I think that ultimately comes down to this philosophical viewpoint about how markets behave. Now, Harold's definitely got his philosophical viewpoint about how trends emerge. When I listen to Harold, he's a very clever bloke. He's got he's targeting different facets of trend to what we're targeting. So that tells me that there's a lot of edges, different forms of edges to be exploited in this divergent trading method that we apply. I'm less courteous to those who embed convergence into their models. And the reason for that is that accompanying convergence is a problem of timing and negative skew, which therefore is deliberately, it's not deliberately, but it's integrating negative skew into the portfolio, which is damaging. So it's very complex, Jerry, but our particular approach, I think, is very concentrated towards these outliers. It's interesting. We talk about diversification all the time, but our particular philosophy is very concentrated. But that's exactly how I like it.
Yeah, I enjoyed Harold. Finally, someone else on, Top Traders Unplugged that Niels may have to apologize for. He apologized for my comments once to his audience. And so Harold going off after AQR was kind of funny. He was not giving up. I think Niels tried to steer him away from, it's not about AQR, but Harold was pretty intense on giving them the business. And I thought that was kind of funny. Although I love AQR, I love
Do
Cliff.
you think that's what when Alan Dunn and Niels were talking in the last podcast, they were talking about they won't mention anybody's names, but they're sort of more egalitarian and allow all of these different views. But some people are more. He was having a go at Harold there, wasn't he?
Oh yeah, probably. I mean, he did the same thing. After my last appearance, he told Alan that, Jerry, I was shocked at what Jerry said. I could not stop him from saying it, and I could
I remember
pretend.
that.
I could pretend that I don't know what it was. I don't know specifically what it was because there were so many things I was saying that could be offensive, and I felt bad. And I
No,
apologize. I
that's when you were having a
apologize.
go at that's where you're talking about. What were you talking about? The CTAs. You're referring to CTAs in a derogatory manner.
Oh, mismanaged futures. Yeah,
That's it. That's it.
yeah, yeah. And so, yeah. So, anyways, but Harold's a really good character, and for something about that guy, I just really like listening to him. I mean, he could like curse me out, and I think I would say that's really funny. I really enjoyed that, Harold. He's just got a really pleasant way of disagreeing with you, and coming up with his own ideas that it's really fun to listen to. It would be like a really fun part of my life to meet him in person and have these discussions over a dinner or wine or something. But yeah, I think I wanted to get back to one other thing that Absolute was saying earlier, and I wanted just to comment that I think that in some sort of strange way the classic trend following cares a lot about smoothness and volatility. And if someone looked at some of these portfolios with 300 markets, 500 markets, they might say, you are obsessed with this risk and diversification and maximizing your smoothness as much as possible. And then, the classic trend follower would say, well, kind of, I mean, I'm really doing it for small bet size and to capture as many outliers as possible. And I'm only interested in these ways of making things smoother if they're free, if they don't come with any downside. So adding markets, no downside, adding more systems, no downside, totally free, can only do anything. The only thing it can possibly do is make things the same or a bit better. So yeah, it's really a fascinating strategy. But I do think that I was trying to get you to talk more about the whole idea of robustness and loose pants. And I think there's kind of two different things. I think if you draw a narrow path and using some of these other techniques, they're based upon the back test, and they're really trying to use that in the future, that this is what those big trends are going to look like. This is what the losses and the wins are going to look like. And it's too much precision. And I think that's our ultimate complaint. And I told my friend at coffee the other day, we were talking and he was giving me some of his opinions. And I was like, no matter what people say, we always have our ace in the hole. And that is, you're going to get yours eventually. And that's, I think, whether it's true or not, I'm laughing at myself because that is ultimately, what we're afraid of. That how long can you go with these too prescriptive type of systems where you're adding to positions and it doesn't seem to matter, and then it all crashes and blows up. You take off positions and it doesn't seem to matter, but then you see the biggest trends of all time, which would totally invalidate your back test. And I think this is what we're in the back of our mind always is, you can be the next Kathy, you can be the next Chase. Because look, these people followed their system that had been tremendously successful. You think you're smarter than these people? I don't. And so, yeah, this is the problem. They eventually got because of these weaknesses in their strategy that took a long time to show up.
Exactly, Jerry.
Every strategy and system is subject to that risk.
I agree. And that's why the best system on the planet, historically, robustness-wise, and in the future, could possibly need some sort of position reduction rule that cuts back those positions during bad drawdowns, drawdowns you've never seen before, at a faster rate than you're losing. The turtle cutback rule. And overall, that rule will make you make less money because it's a non-system trade, but it will help you meet your first and foremost requirement, which is staying in the game. All right, I got to go to New York, and it's very cold up there. I'm leaving Tampa for New York for some reason, for a weekend of fun. And I've got all these nice winter clothes that I'm never able to wear down here. So looking forward to that. Okay, 2 hours. It's been fun. Thanks for all the comments. Thanks for everybody for participating, keeping your cool. And I really enjoy these, and I appreciate everybody, especially Absolute. He brings a lot of flavor and growth. We're not going to grow if we don't have people disagreeing with us. All right, so have a good weekend, and we'll see you next week, same time.